Hit it.
It's Friday, December 18th, 2020, episode 110. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Michael Gayad from Toroso Investments. We have a great discussion about different strategies to help navigate these interesting markets. Then in Talking Charts, Patrick regales us with his usual voodoo magic. Let's hope he tells us more than buy it if it goes higher and sell it if it goes lower.
Oh, and this week in trading history, we go back to 1971 for the U.S. dollar devaluation, and we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We have a great show. Lena, hop on. What are we drinking this week?
This week, we're drinking Big Spruce Brewing Company's Tag You're It IPA from Nova Scotia. So something about this beer, it's an intensely tropical and generously hopped IPA brewed in collaboration with the Ocean Tracking Network, where 50 cents from every can goes to support local and global marine animal research and education.
Nice.
We're helping the dolphins.
That's right.
Yeah. 6.5%. It's on the stronger end, but it actually tastes pretty good. I like it. All right.
Nice.
Let's get on with the show.
Nothing in this podcast should be viewed
disclaimers.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show.
What, there's no side effects, Kev?
Patrick, this was a busy week for me.
Yo, you dropped the ball.
With
Jesus.
the rebalance on the S&P, I was just so busy. Now, top it all off, I am running out of ideas. So, in the past, we've had a few kind of write-ins from our listeners. So I would kindly ask if anyone has any side effects, please either tweet them or email them to us, because Lord knows we have completely exhausted our limited kind of
list of diseases,
imaginary kind of things. Anyways,
let's get on to our first interview.
It's our pleasure to welcome to the show Michael Gayad from Toroso Investments. Michael, thanks for coming.
My pleasure. Thank you.
It's going to be a lot of fun. I've read your stuff for a while, and I'm fascinated. I'm looking forward to hearing about your lumber versus the stock market, because it is one of the few things that you're one of the few guys that'll talk lumber. So I'm looking forward to that. But before we get into all your wonderful market insights, why don't you tell us a little bit about yourself? How did you get into this industry? What's your background?
Yeah, sure. So I kind of had a lot of exposure by osmosis. So my father had worked for Bob Farrell in the late 80s at Merrill Lynch. For those that are not familiar with the name Bob Farrell, I encourage you to look up Farrell's 10 Rules for Markets. He was sort of this legendary technician at the time that was very widely followed. My father was on his team, wrote 2 books on markets, and started his own investment firm in the 90s, eventually started up a hedge fund, and kind of grew up at a young age watching the development of my father through the industry. In 2008, he passed away. I was not of age to take over the family investment advisory firm, had to reinvent myself, had a short stint working with a family office in Geneva, and then joined another RIA where I ended up launching a mutual fund, kind of baptism by fire, kind of doing it without any real experience. And thankfully, things have kind of worked out very nicely over the last 10 years as I've built a name and put a lot of hopefully thoughtful research out there.
I'm just looking at Bob Farrell's 10 Rules. Do you have a favorite?
I have to remember them off the top of my head, too.
Well, here, I'll read them. Do you know what? I'll read them
please,
so you... Markets tend to return to mean over time. Excesses in one direction.
That's probably the most accurate one. So, real quick on that. So when I was on the road, I used to always say at CFA chapters that the one thing you can count on when it comes to markets is mean reversion. And mean reversion is a concept that's as old as the Bible, right? Because he who is first shall be last, and last first is the very definition of mean reversion. The problem in markets, of course, is you don't quite know where the mean is. It's constantly changing, but you can probably stop right there. I would tell you unequivocally that's probably the number one rule when it comes to markets.
I'll read them just so everyone else that kind of knows them. Excesses in one direction will lead to the opposite excess in the other direction. There are new eras. Excesses are never permanent. Exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. The public buys the most at the top and the least at the bottom. Fear and greed are stronger than long-term resolve. Markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names. Bearish markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. And then finally, the last 2, when all experts and forecasts agree, something else is going to happen. And the last one is bull markets are more fun than bear markets. And I guess that leads us to what's happening now. There's no doubt we're in a bull market. Is it a fundamentally justified market?
So, and by the way, I retract my first statement. Quite literally, any single one of those would apply to the environment that we're in today, from Farrell's rules. I appreciate you reminding me also of those. So look, I've been putting these tweets out recently on @LeadLagReport. I mean, it's remarkable to me that everyone was so convinced of the end of the world in March, and everybody is so convinced of an enormous bull market now. I use this line quite a bit, that opportunity always exists when the crowd thinks it knows an unknowable future. And I think the sentiment is so unbelievably one-sided now that it's clearly not fundamental. I've jokingly said multiple times throughout the last several months, this is the most bullish depression in history, given the way equities have behaved. Look, I talk to a lot of advisors day to day, right? I run a mutual fund, I run an ETF, RORO, and advisors always say to me, none of this makes sense. And I tell them, well, actually, I disagree. It makes sense because the Fed is telling you they're manipulating it. I mean, it's not, let's call a spade here. The Fed, when they came in and decided earlier in the year to stave capitalism with socialism by buying up unis, corporates, and junk debts in the name of the pandemic, they basically said outright they're willing to just kind of completely break the free market capitalist system. So it makes sense from that standpoint. Now, the question, of course, is, can the Fed manipulate this forever? Yes, you've got a printing press, but at some point, the debt bomb that they are building themselves gets so big that I find it hard for even them to try to counter it. So I think, it's clearly a bull market. That's not to say that you can't have a very sizable surprise decline in the context of forced reflation that's coming.
In what way? Like, in how? What would you see that sizable decline look like?
So everything for me is about conditions, right? I always say that conditions dictate probabilities, probabilities dictate outcome. I don't believe I'm a forecaster, right? I believe all I am is telling people the weather based on historically proven leading indicators to risk. So everything for me is, where are the conditions that favor the accident in markets? And, I put out these various award-winning white papers over the years that I've presented on all over the United States. And each of those white papers documents various leading indicators to those conditions. All of the leading indicators to risk have one thing and one thing only in common, which is that they are all interest rate sensitive. Utilities are a leading indicator of stock market risk. The yield curve is a leading indicator of stock market risk. Lumber to gold is a leading indicator of stock market risk. Everything at the core is about the demand for capital. Now, this has been confirmed in the last several weeks here, the way the market has rallied entering 2021, in the sense that all of the leading indicators to risk have been saying risk on. Utilities have been weak. Treasuries have been largely weak, not as weak as I'd like to see it. Small caps have been strong. Lumber to gold has been on fire on the upside. So you have a lot of confirming intermarket relationships that suggest that the near-term sentiment is quote-unquote justified, but mean reversion still exists. And at some point, these extremes, to Farrell's point, get resolved with another extreme on the way down. The indicators are not there just yet, at least the way that I look at markets and the way that I run money. But I think with this kind of environment, you have to be very careful not to get too complacent and not to take on way more risk than is justified given your risk profile.
What do you think what would be an example of a leading indicator that might say that the correction is closer in time than the market expects?
So the three ones that I kind of most closely track, and I track them because I run the ATAC rotation mutual fund, which as of this conversation, mid-December is up north of 70% year to date.
70%, just for those who are listening. 70%.
Yeah, among the top performing tactical mutual funds. And it's top performing because I got the risk off before the COVID crash, right, being in treasuries in advance of the decline, and then risk on pretty much a week after the low. All
and
intact.
how much leverage would that fund use?
When risk on, it uses 1.3x leverage.
Okay, so it's not a highly levered fund.
Right, and so maybe taking a step back. So when I say risk on, risk off, I go back to it's not about direction, it's about conditions, right? When you look at studies on car crashes, most people tend to hit the brakes after the crash. They tend to react after an accident. When you have a mindset of trying to approach things from the standpoint of the weather, the conditions that favor the accident, and you track these indicators, you can position defensively in advance. You might be wrong, but when you're right, you're really, really right. So most performance in the ATAC rotation fund and even in the ETF RORO, risk on, risk off, comes not from the upside. It really comes from the avoidance of the downside, right? Okay. Sort of the argument that to kill it in the stock market, you have to not get killed. The problem is people are now starting to forget that, even though it's only been 9 months since we saw a period where markets were freezing up and you were having circuit breakers kick in. It's amazing how short-term people's memories end up being when you're in an environment like this. Down capture matters more than up capture. This has been an unrelenting period of up capture. The fund's performance is not really so much driven by the upside. It's more by the avoidance of the downside and then getting back risk on at lower levels. Okay. I don't like buy high, sell higher. I'm very much a buy low mentality, and that's hard because FOMO, fear of missing out, is a very real phenomenon.
Right. So you were saying that you have three indicators that are kind of are they the bedrock of what you watch for in terms of would give you kind of clues in advance that you should be heading to the sidelines a little bit?
Yeah, and really what those are is, it's again, it goes back to utilities, treasuries, and lumber relative to gold. So historically, when you go back to the 1920s, as documented in the 2014 Dow Award paper that I put out there, when you go back to the 1920s, when the utilities sector, most boring sector of the stock market, when utilities are outperforming the broader stock market on a very short-term basis, you tend to see stock market volatility rise on average afterwards. Same kind of deal with treasuries. When you have very long duration treasuries outperforming intermediate, it's not based on my opinion, just fact. Quantitatively, historically, you tend to see higher stock market volatility afterwards. And it's not some random correlation. The reason those two are leading indicators to risk is because they tell you something about interest rates, the demand for money falling. Utilities are the most bond-like sector of the stock market, so their movement tells you a lot about changes in the demand for capital, changes in growth and inflation expectations. Treasuries, as you know, obviously are interest rates, so you want to see yield curve steepening, not flattening. And then when it relates to lumber to gold, it's kind of a strange concept. What is it that two seemingly unrelated commodities have to do with equities? And the link there is really around housing, right? So we know that lumber is a leading indicator of the economy, or housing is a leading indicator of the economy. Lumber is a leading indicator to housing. So the argument goes that as lumber performs, there's all kinds of ripple effects on future housing and construction activity, and all that has all kinds of implications on the wealth effect, credit creation. So when you compare lumber's performance against gold, which is more of a safe haven commodity, it also tells you something about, again, the conditions that favor an accident. On the lumber to gold ratio, it's actually really quite interesting. So in every single major period of market stress, lumber to gold warned in advance of a collapse. Prior to the 1987 crash, lumber to gold weakened. Prior to the 1990 housing recession, it makes sense, it's housing, lumber to gold weakened. 2000, 2001, 2002, every time lumber to gold weakened, you had a VIX spike afterwards. Again, it warned in advance. Even in 2008, 2 to 3 weeks before Lehman, the signal flipped to risk off. And even this year, as documented in the lead lag report, it was mid-February. So in every single major stress period, you ended up having a warning sign in advance, slow down entering the storm. And again, even though storms are relatively rare, if you can avoid them, you end up really making quite a bit of money in the markets by, again, not getting killed. The key to this stuff, though, is you don't know which signal is the one that's gonna with hindsight, be the one where a crash happens afterwards. You have to keep on following, right, your system. You have to keep on following your approach, because only with hindsight do you know which signal was the true risk off. You might have a lot of false positives. That's okay, because when you're right, you get 70+ returns like I did in the ATAC rotation mutual fund.
So, Michael, I love this lumber to gold. I think it's fascinating because so few people watch it. Like most people don't even realize it's traded. And yet here you are, you're using this indicator and to great success. I have a couple of questions for you. First of all, how did you stumble upon this? Like, what was the genesis of this kind of insight?
So, a lot of the media, and you often hear this, when you hear some pundit, they talk about typically copper and oil. Typically you end up hearing Dr. Copper is a leading indicator, oil is a leading indicator. So initially did some testing around copper and oil, and then it was just sort of an aha moment where you realize, well, most people's wealth is in their homes. What's the key material that goes into homes? It's lumber. It's wood.
Right.
And then when you start kind of digging a little bit deeper, you start realizing, well, this is interesting, right? Because lumber is actually regulated to some degree, meaning that in response to the Endangered Species Act of 1973, Congress removed a large degree of rainforests from being deforested to protect endangered, near extinct species, right? Their habitats. So it shrank the available supply of lumber out in the marketplace. You can't necessarily grow a tree overnight, obviously. So the price of lumber ends up being a very good pure play on demand for housing. So when the testing started taking place, it became very apparent that this is perhaps one of the most important commodities to track, and nobody talks about it.
So do you think that there's like Jim Simons and Renaissance and other quant shops have figured this out? Or do you think this is a relatively unknown and still is it just not talked about, or is it truly as unknown as we think?
Oh, I'm sure the very big guys, probably do track it among various other areas. I think the truth is it's not interesting, right? It's not sexy to talk about lumber. People want to talk about metals.
We're Canadian. Lumber is very sexy. Like for us, that's a regular day is talking about the tree stocks. So the other thought I had while you were chatting about this, and you were chatting about the bond market's performance and the fact that when you see long-term treasuries do better than what was it versus utilities? Is that basically the crux of your argument? You're watching treasuries versus utilities to give a signal?
So it would be long duration treasuries against intermediate, so a form of yield curve flattening.
Oh, okay.
Right? Sort of like the longer end of the curve, right? You get more money chasing some of those longer duration treasuries, and then utilities against the broader stock market. The two tend to confirm each other. Okay. Right? In other words, because utilities are so levered, you tend to see treasuries also strong because utilities benefit when rates fall because the bulk of their earnings are not driven by revenue, it's by the cost of capital. So you'll tend to see the two kind of confirm each other.
Sorry about that. So now, are you worried as we enter into these low rate environments and the bond market is being crushed to oblivion with the rates at almost at zero? And if you go look at Japan, Europe, their bond markets have been ruined completely. Are you worried that this signal in terms of the U.S. is in danger of no longer working?
The thing is, I've been worried about that for 5 years, right? And this year clearly is the worst. I mean, everyone's been saying that for forever. I mean, as we've seen, rates can go lower. Now, the key is the causation, right? So let's say you have an environment where rates are rising. That's actually supposed to be bullish, right? Because it means the demand for money is increasing, activity is increasing, inflation expectations are rising. That should all be risk-on favorable for equities. It's when you're in a world where the market views ongoing low rates as rather the direction of the yield curve in terms of flattening as being bullish. That's where things kind of get screwy. So with the low amount of basis points and interest rates here, it doesn't seem like there's anything different on the signal. It just means the signal maybe is more volatile because every basis point obviously makes a bigger and bigger difference, at such low levels.
Right. Okay. So the other thing is you mentioned you were chatting with a lot of investment advisors or clients and things like that. Walk me through what you're seeing out there. Is this purely the FOMO, or is it a function of there's a lot more money to be put to work? One of the theories that I have is that there's actually a huge embedded short position in that people need to save in their retirements. And after the '08 crash, they were always underinvested stocks. And so this has been the relentless bid that we've seen. Give me some pushback or some color in terms of what you're seeing out there from that community.
Yeah, I mean, look, I think a few things, right? So the thing that everyone's really kind of most honed in on, which has been a widowmaker spread trade, has been this kind of argument that value starts to come back and growth underperforms. Growth being primarily tech, value being primarily real reflation trades, meaning financials, materials, and energy. And you saw a pretty big move coming out of the U.S. election, and then it sort of petered out, and tech came back, and there's still sort of a bigger question around that. But what I've been seeing kind of more recently is I think that rotation may finally be here after 10 years of waiting for it. The reason I'm saying that is there is a link to inflation expectations and the value style outperforming the growth style. Why? Because tech is disinflationary, energy materials are inflationary, financials benefit from a steeper yield curve, and you're seeing the U.S. dollar really start to break down pretty heavily. So if the Fed does get its wish on inflation being higher for longer as they keep rates low, longer rates will probably rise, and you'll probably see a pretty big shift into commodities, and that has all kinds of ripple effects on asset allocation going forward. Now, if I'm right about that bigger trend, that's a pretty tectonic shift, right? Because that means that tech no longer is the leader. Seems impossible, but certainly can happen. It means that all the areas which have lagged for a large amount of time end up suddenly leading. It also probably means emerging markets become the place to be as opposed to the U.S. markets. And it, in turn, probably results in more risk-on, risk-off, boom-bust cycles, more volatility in general in that kind of a environment. So, I do think we're on the cusp of something perhaps pretty bigger in terms of a cycle change longer term. And as you know, the problem with talking about cycles is that you don't know if you're in a new one until 2 to 3 years after it's already happened.
Right.
So we may already be in it.
So in your mutual funds that you manage, will you position yourself to take advantage of that, or are you just? Is it more of a mechanical thing, and you're looking at this saying, in fact, this will help my risk on, risk off, and all my stuff because, all my systems, because the reality is that there might be more on, off kind of behavior.
Right. So it's more the latter, right? So the key for anybody that's risk on, risk off in their approach, in the case of the mutual fund and the ETF RORO, it's all rules-based, mechanical, very short term. I mean, the turnover is north of 1,000%, just to give you a sense, right, of the kind of rotation. So there's very few things that are as active as that, and it's active because the anomalies only live in the short term. This idea that utilities, treasuries, lumber to gold are leading indicators only happens when you have these bursts in the very short term of strength in the case of utilities and treasuries, weakness in the case of lumber to gold. So it's not sort of a positioning argument, but it goes back to what you just referenced. I've made this point in a lot of writings, a lot of content, in the lead lag reports that I publish daily. Risk on, risk off is just code. It's code for saying inflation or deflation, right? Because when you think about it, under what conditions are utilities weak, treasuries weak, is lumber to gold strong, reflationary hope, which is largely what happened out of the lows this year. Under what conditions are utilities strong, treasuries strong, is lumber to gold weak, risk off, I'd argue deflationary reality. And given that, we couldn't pay off our debts before this, not just in the U.S., but everywhere, and God knows how bad it's going to look coming out of this, without being overly dramatic, I can make the case that this is the only question that matters for many years to come. It's not about what the next hot tech stock is. It's, are we going to be in an inflationary environment, or is this debt bomb going to go off and it's a deflationary depression? So that sounds like more risk on, risk off. That sounds like more swings, which is by no means a guarantee that any of these signals work. But, you have an approach that thrives on down capture, on risk off. You need some down capture and risk off to thrive, right? You need a cycle that favors those swings. This year was the extreme. I don't think it's over yet.
In what way? You think that we're gonna have more of those kind of sharp events where you might have a month of risk off? Is that what you're looking for?
Yeah, I mean, basically what I'm making the case for is that the environment of the last 10 years, which has been dominated by, up until this year, large cap only, very smooth and very passive, is probably over, right? Because so in other words, this kind of Vanguard only driven world of just cheap beta, probably has resulted in enough new anomalies popping up to allow for some active management and swings to finally work. And I think that's really kind of important, right? There's this concept called the Grossman-Stiglitz paradox, which, long story short, makes the case that for passive to work, you have to have active anomalies arbitraged away before passive works. But then when passive works, now the anomalies that were arbitraged away start getting bigger because fewer other people are looking for them, because passive is the only thing that was working, so they go out of business. So you have this constant pendulum swing back and forth across active and passive, and people forgot that passive is only efficient when people have arbitraged away active anomalies. Well, if there's no more active managers, suddenly the anomalies come back for a multi-year cycle, right? So this is why I think this is going to be really quite interesting, because I think a lot of people will be caught off sides if I'm right in that dynamic.
So that's fascinating, Michael, because I have intuitively felt the same way. I've always thought that when people tell me that passive is going to ruin the market and all this stuff, I push back and say, you know what the cure for low prices is? Low prices. What the cure for high prices is? High prices. And I've argued that the more people that do passive, the easier active becomes. Now, I didn't realize this, but somebody, a lot smarter than me has already articulated it. So what is Grossman-Stiglitz? Have I got this right?
The Grossman-Stiglitz paradox, I think it was from the early 80s, as I recall, is when that argument came out.
And did they write a paper on that? Can I go find that?
Yeah.
Or did you write a paper on it?
The readers, yeah. And it's on Wikipedia. It's kind of it's an interesting argument about sort of just the idea that active beats passive and vice versa. Right. And that's kind of the key to this, right? I think people forget, again, that cycles exist. Passive is a strategy. Large cap weighted, that's a type of a strategy. Every strategy has periods when it works and when it doesn't. Buy and hold, only works when people hold. Most people tend to not hold, in volatile cycles. That's probably why buy and hold works over the long term, because very few people actually hold. But cycles are still alive and well. So I just think that you're going to be entering a very different future than what we've seen in the past, given everything that's happened this year.
That's fascinating. So one of the things I'd like to chat about is coming out of the COVID crisis this March. You were smart enough or not smart enough, your system was smart enough to go and actually highlight that it should be risk off. What were, how close to the bottom did the indicators start to get you back into the market?
Was pretty much the week after. So I was writing on Seeking Alpha, and those articles are dated. February 27th, I said we may be in a crash, and here's why. March 6th, I wrote a piece titled the Melt Up to Come, and I was making the case March 6th that the setup was actually that towards the end of March you'd probably see a pretty sizable risk-on period. And then March 31st, the one I'm perhaps most proud of, was the article titled "No Longer a Melt-Up, Why the COVID Bubble is Coming." And back then I made that case. You can Google that. You can see it. It's not with hindsight. It's all there. What I was making the case back then is what everyone started realizing months later, which is that the policymakers probably overreacted to COVID. And in the midst, it was a very scary time. Obviously, what was happening in February, March, and tremendous losses were had. But one of the key arguments for me at the time, just subjectively, even independent of the signals, having gotten it right, was very obvious. If this is the end of the world, all of our money is worthless anyway. So you might as well bet it's not the case.
Right. It's one of those Cuban Missile Crisis moments where there was a time on the Cuban Missile Crisis, it was over a weekend, and the trader on the floor ended up buying everything. And the young guy said, "Why are you doing that?" And the old guy said, well, if there's nuclear war, it's not going to matter. And if there's not nuclear war, it's going to go up.
Right. Exactly right. And I'll take it even a step further. I mean, it was really remarkable. I'm a big fan of behavioral finance and heuristics. And the availability heuristic was was unbelievably high at that time, because when you would turn on Netflix in the midst of everything happening in March, the top movies and shows were Walking Dead, Pandemic. It was all apocalyptic movies. So people started thinking it was going to be like Hollywood. That's why toilet paper was getting sold out everywhere, right? It's actually, when you look back, I mean, there's some real interesting psychology to how this ended up playing out. And I kept on seeing that, and I kept on seeing these signals, and I kept on seeing this sentiment be so dark that even in the writings, I was saying this doesn't make sense. This is completely irrational and illogical, because we're going to probably get it under control, and you can debate whether it is or is it now, but at the time, it's just everyone was so convinced it was the end of the world that all the money was to be made on betting it wasn't.
Right.
Right. So, and if you followed a systematic approach, you'd be able to go risk on, and not have your emotional biases prevent you from doing so. I will tell you, when the ATAC rotation mutual fund went risk on, I myself was wildly nervous, right? As much as I was coming across as the kind of, pillar of strength, I was one of the few in the media basically making a bullish case that this was not the end of the world. It was a very uncomfortable feeling. I don't know if I could have done it had it not been for a rules-based approach, right? So I'm very much a fan of just quant signals for that reason, because you have to take away the emotional aspect of money management, and you have to do so relentlessly. Otherwise, you're going to keep trying to think that you know the future when nobody does.
And are those signals today still like all systems go, or are there any of them that are flashing the warning sign?
They are, but I think that some of the they're still, everything's kind of still largely risk on here. But I think that we're getting to a point where the mean aversion in the leading signals may be coming closer than people think. And it goes back to, if you have mean aversion in the leading indicators of risk, that means risk is to follow likely afterwards. It doesn't mean you're guaranteed to crash, right? It just, I always use that analogy. Just because it's raining doesn't mean you're going to crash. Just because it's sunny doesn't mean you won't. Right? It's all about conditions, probabilities, and outcome. Right now, it still looks like things are okay, but I just, I like to kind of caution people that the future is incredibly unknowable, and don't take these gains for granted, because they are not guaranteed.
Well, Michael, I'd like to thank you and say it's fascinating stuff. Why don't you tell people where they can learn more about the papers you write, the mutual funds that you manage, and all that other great stuff?
Yeah, no, I appreciate it. I mean, you can follow me on Twitter at Lead Lag Report. The mutual fund and ETF, ATACX is the mutual fund. The ETF is RORO, risk on, risk off, RORO. You can see that at atacfunds.com. And if you just Google my name and then SSRN, you'll find a repository of the 5 award-winning white papers I put out since 2014. I appreciate the invite, guys, and hopefully everybody and your audience stays safe. And remember that risk off always matters more than risk on.
That's great. Well, that's wise words to live by. Have a happy holidays. Thanks for coming today.
Cheers. Thank you.
Okay, Patrick, time for talking charts. What do you have?
Well, first of all, let's go through our top 3 things from last week and the top 3 things we're watching this week, right? So last week we started off talking about the central bank action. What was your take on the Fed and everything?
Well, the other ones were kind of a non-event, but the Fed was interesting in that the market interpreted what Powell said as extremely dovish. I was surprised that the market interpreted that so dovishly. I've argued for a long time the Fed has told us time and time again they are going to be dovish. It seemed to be that this crack over the head with the baseball bat got them to wake up. And although there really wasn't that much new that he said, he gave a little bit of guidance in terms of the QE program and when they're going to, the forward guidance on when they would alter those programs. But otherwise, there was not much new, but the market was very excited about it.
All right. Well, let's talk about number 2, which we asked whether the market was just taking a pause or whether it was a bigger correction. It was just a pause. Clearly, the quad witching, the Tesla inclusion into the index, all of these things gravitated the markets to the top end of their ranges. It wasn't really a big rally, but it certainly wasn't this big correction. But now that this event has come, which is our number 1, which was with quad witching and Tesla that we were looking at. What's your intuition for next week or over the holidays as to how this plays out?
I don't know. It's interesting, Patrick, because a lot of times the quarterly expiries are, let's just say, changes in trends. If you have a rally, it can often peter out at this point, or if you have a big sell-off, that quarterly expiry can end up being the switch, even though we were kind of market participants are looking for. I want to say that that's going to happen, but it just feels like there's just such a wall of buying out there. I'm not sure it is, Patrick.
Well, I still think that there's lots of room for volatility. Brent was on the show from Spot Gamma talking about how much different options were open at the different strikes into this December expiry. That's all rolled off. And the gamma pin was up into 3,700, and we literally closed right near 3,700. Now that's all off the books. Now the market's going to be unpinned. Maybe the long-awaited correction may get underway here next week. But obviously there isn't even any sign of selling, so I need a little bit more evidence for that. But let's go through this the top 3 things to watch, but not only next week, but because we're going to have our Christmas special running, we decided that these are the things we're watching into the end of the year. And so one of the things that you were asking about, does Santa Claus come to town? What's your thinking?
Well, first of all, I just want to tell people that everyone thinks the Santa Claus rally is during the whole month of December. And it's actually not. The Santa Claus rally is the tendency for the stock market to rally in the last week of December and the 2 first trading days of January. So in fact, it's almost like the Santa Claus rally / hangover. And I see no reasons to assume that he's not coming. I know it's been a lean year for Santa Claus. He's had a lot of work to do, and because it's the COVID, he's had to do a few extra presents. But I still think that I don't see any reason to assume that we're not going to get that same rally that we often get at the end of the year.
Kev, let's go to number 2. And number 2 is that is this a breakout in precious metals? And you know what? I don't want to always get overexcited about a few up days. But one interesting thing about gold was that it was really on the COVID drop. On the vaccine announcement drop over here, where we had the $100 down day, where a technical level of the 50-day moving average was broken. And we got all the way down to the 200-day moving average and tested it, no different than we did back in March. And then for the first time, we had a close above the 50-day moving average since that vaccine news. And one day doesn't make a new trend, but often there's a lot of people that use that 200-day and 50-day moving averages as arbiters of their trend and trade positioning. And I think it's going to be one of the really interesting things to watch in the next couple of weeks, whether that's a turn. And that's not only in gold, but let's say even just take silver. Silver's now 3 days broken above its 50-day, including actually breaking that high that was established in November. And so it'll be really interesting to see whether these things follow through. And that's definitely what I'm watching. Any comment on that?
Patrick, just a little bit of a pat on your back there. A couple of days ago, you alerted to me to that silver breakout, and I didn't listen to you because, let's face it, I rarely listen to you ever. And I should have paid attention. So kudos, bud. Well done.
So number 1, does the dollar bottom by the end of 2020? And this is an interesting one because there is no denying the downtrend is very well established and very much in play, right? And so we have a scenario where the dollar is breaking down. It really does feel like that 2018 low on this dollar index, which was established down here along the 89 level. Seems that it's very probable it's going to get tested. And so that's likely to happen, or at least there's a very reasonable chance it will. But will that mark a swing low, and will the dollar have that reflexive rally or establish some base from which it will turn off that level? I think that's definitely something to watch. What's your intuition on it?
Patrick, it feels really oversold. It feels like very few people are looking for it.
Very consensus.
Yeah, very consensus. The dollar's going lower. I still think the dollar is going a lot lower but I don't know if I'm being too cute by looking for a bounce, and I think it's going to come and it's going to surprise everybody.
I think the bounce is coming as well, but I feel that it doesn't mean it's coming early next week. I think that you just need to be a little patient. The way I would put it is that there isn't much asymmetry in continuing to short the dollar. I mean, if you want to if you're already been short for a while and you want to squeeze a little bit more, you can press the trade a little bit. But this is not a tactical time to be putting on new dollar shorts, is the way I would put it. Anyway, let's talk some charts though, Kev. And I want to start by talking crude oil. All right, like this thing doesn't want to quit.
I don't know. I find that all the guys and gals that trade crude oil, they're all bearish all the time. It's like the more you know about it, the more bearish you are about it. I don't know why they are. I contend that this is headed higher. What did I say? I said I thought you could see double-digit crude oil next year, and I'm sticking to that.
Okay, next year that's fine. So, but we're talking about the most immediate trend. And one of the things that I've been watching with members, I remember, and I'll give you kudos.
1 second, Patrick, before you do anything, I realize this has been a long day for me. For those who don't know, double-digit crude oil. We're in double digit. I meant triple digit.
Oh,
Patrick, you're supposed to figure me. Listen,
I'm drinking this the 6.5% Big Spruce beer. I missed that.
Anyways, I interrupted you saying that you were going to say.
Well,
something
you have
nice
to correct
about me.
yourself. Yeah, no, but I was looking for a bottom somewhere in the low 30s. But when crude oil was down here, you went out there and you tweeted that you were buying, like right at the bottom.
Oh God! Even the blind squirrel finds an acorn every now and then.
Yeah, I mean, you freaking nailed it, buddy. Anyway, but we were targeting this thing if it broke out to come up to about this $50 level. And you know what I feel? I feel there's going to be a bigger intermarket event where I think that you're going to see within a week of each other that you're going to see the dollar bottom that you were just talked about create a swing high in oil. That doesn't make it bearish. It doesn't make me think that oil's going back to 35 or something like this. But I think that this existing rally, this advance that's come up towards this $50 level will stall and mean revert, maybe back down to the mid to low 40s in a period where the dollar is getting some reflexive snapback rally that may not actually be a new uptrend. It's just things are so oversold that some sort of a reflexive bounce is a par for the course here. And I know that Michael was talking about that earlier about mean reversion, and these things have all kind of got ahead of themselves. And I think that it's going to be happen within the same window of time.
The Patrick, the problem is that there's so many charts; they all look the same.
Yes,
and they all feel the same. Whether it's the dollar, whether it's stocks, whether it's crude oil, it's all these extended moves, and you're just. You can't bring yourself to hop on board because it's gone so far, and it doesn't seem that fading it has been let's just say advisable considering it's been a one-way train, and it's frustrating. It really is. That's why maybe just take some time off and see what the new year brings.
I've been telling a lot of members that it doesn't. It's okay to stay with it. I mean, if you've been long, let's say crude oil from the low 40s, and you want to try to squeeze another dollar out of it, I mean, you could keep pressing it. The one thing I think though is it's just not a good new trade. So I mean, if you've been in this trade and you want to try to, and you're willing to trailer some stop losses or hedge it with options or do something, and you want to try to press it for more, that's okay. But I just think that it's a tactically a bad time to be joining in the party here if you've been on the sidelines up until now, right? What's interesting as well is I want to talk about copper. So this thing doesn't want to quit. I mean, it's going full crypto on the upside, isn't it?
Full crypto. That's going to be the new thing. Yeah, copper is. Patrick, I wrote just so you know, I wrote this piece saying how if I ever sold copper. To my readers, I say you should give me a hard time. And then I went and I sold.
And you sold it?
I didn't sell all of it. I kept a little piece, but yeah, I sold the vast majority of it. And I didn't get enough flack from my readers. They should have held my feet to the fire because look at this. It continues to go higher. I really think that copper, you shouldn't overthink it. You should just be long. And I'm
You know
an
what?
idiot for
No,
letting myself get shaken
I
off.
think you did the right thing. Stop it right now. Let's use.
I was unsure whether I had done the right thing before, and now I am absolutely sure that I did the wrong thing.
Because I said this.
Yes.
All right. So what I want to show you, and I think this is very relevant. All right. Let's go back to copper's rally off the 2009 low. All right. So copper crashes. We had a crash as well in March, and the first rally in copper off of the low, it goes from like $1.25. And over the span of just about a year and a quarter, so let's say 15 months or so, the copper goes from $1.25 up to $3.75, very close to the very level we're trading right now. But then once it hit those highs, it spent over 4 or 5 months giving back and consolidating before that next leg higher to 475. I think that while I agree with you that copper is going higher, I think it's overdone, and I think that the way that this consolidated here in that first part of 2010 is a scenario that can play out here as well. Which is that I'm bullish copper. I think that copper is still the right place to be, but it's overdone. I don't think you made a mistake by taking some off the table. I think you're just suffering from the fact that you're watching it going higher and you feel a little bit left out, right?
It's going to be $4 next week.
Yeah. Well, look, it's making higher highs. There is absolutely nothing stopping it from, well, at least 375. I don't know about 4, but there's nothing stopping it from printing up 375 by next week. I'm with you on that. What's interesting, I wanted to talk about that uranium participation unit because this rally in uranium participation unit happened without a big move in uranium futures. So that net asset value of that of the corp actually narrowed on that move. I mean, obviously, uranium suddenly got hot a little bit. Obviously, Cameco and all of these uranium funds are all working. What's your take? You think that all the excitement on uranium's for reals?
Yes, I do think it's for reals, as 16-year-olds say. I think you close your eyes. There's little dips that you buy. This will be one of the next hedge fund / fast money darlings, and this bull market has just started.
Okay. You heard it right from Kevin's mouth. He's telling you the uranium bull market is just beginning.
It is. It's
all
early.
right. It's early.
Dirt cheap asset, still very unknown. I think these things are all headed. They're going to be doubles and triples in the stock, and I think the same on the uranium participation unit.
Let's talk lumber since Michael was talking lumber. What a freaking like this futures contract is so clean trending. Like there is no zigzagging around here. Like when this thing is going, it doesn't stop, does it?
Yeah, but you're not allowed to ever trade it. It just goes limit up, limit up, limit up. and then all of a sudden it turns and it goes limit down, limit down, limit down.
And you're trapped in it.
You're trapped in it for a week.
Unbelievable, isn't it?
But like, why? That's a question, Patrick. Why do they have something that goes limit up and down so easily? Like, just open that thing up. Let it trade.
Yeah, like they should widen the limits then, right? Like they got to give it a little bit more. I think
it's just so thin. I think that's the reason they don't want. And I think it's probably easy to manipulate because it's such a thin market. Like I think a lot of big hedge funds won't trade it because it's too small. Like they can't go and do any real size in it, so they don't even bother.
Yeah. Let's touch on coffee though. That's a little bit of a breakout. I mean, my intuition here is that coffee's going for a retest of that high. I think we could see 135. You into this idea?
Do you know, Patrick? I've traded almost every single commodity future that I can imagine, and I don't think I've ever traded coffee.
You thrown down the OJ futures?
Yes, I have traded those. Just briefly, nothing really. But going back to the coffee, I feel like maybe I should go break my cherry and go buy it.
Yeah.
Well, a great technician I know really likes this breakout, so maybe I'll go along.
Well, yeah. Okay, there you go. Now I'm not going to say anything else. Anyway, last thing, let's just look at Tesla. Fucking closing right at near 700. And so, and it's funny because that's been a loose target for a lot of people. And there's these measured moves that we do up to this, that we're measuring to 700 to 750. We're pretty much here. One thing that I'm going to watch is does that into Monday or Tuesday do a quick blow off into that, let's say 7.25, and then end down at 650, and it's like one of these 100 down. You've actually been one of the ones that made that call where it's going to have one big up gap and then close down $100 on the day. I feel like if there's ever going to be that moment, next week is about as good of an opportunity for that to happen as any.
You think that we're gapping higher from here?
And then sell.
Nah, I'll fade that.
Oh my God. You know what? Let's save this for a bet. I think we can talk about this in a little bit. I had something in mind, but I think we've picked a topic for us. Anyway, that's enough for talking charts. That's where we're going to wrap it up, buddy.
Patrick, time for This Week in Trading History. What do you have to regale us with this week?
Well, this week I wanted to talk about December 20th of 1971. It was the announcement of a U.S. dollar devaluation as a part of an agreement with other countries in an effort to stabilize the international currency markets. The U.S. dollar would be devalued by 8.57% overnight, and the 10% surcharge on imported goods would be removed. Now, earlier in August 1971, Nixon announced the suspension of gold payments for dollars, and that 10% surcharge was put in there, known as that Nixon shock. This was leading to a weakening dollar, and therefore many currencies of other countries were strengthening. So this was the U.S. dollar devaluation. And at that moment was when gold versus the dollar conversion price, which was fixed up until this period at $35, was moved to $38 an ounce. So many countries were forced to act individually to control their exchange rates of their currencies, and international payments were being affected, and the worldwide flight from dollars continued as the U.S. deficit rose sharply. Now think of it. The U.S. deficit back then was $4.7 billion, those good old days, right? And then
one day's a QE.
Yeah, and the first quarter of the year it rose from 4.7 billion in the first quarter of the year to $12 billion by the third quarter of 1971. Those were big numbers back then, right? And but nonetheless, it was a difficult period. Earlier that year was when the gold standard was removed, and the big inflation came in the period after. But it started with a devaluation of the dollar, and that came in that December 20th, 1971. And just as a little additional history thing, it was also December 17th of 1992 when that North American Free Trade Agreement was signed after 14 months of negotiation. So I just thought it was an interesting throw in there. That was also an important history event. And that's all I got, Kev.
Well, you missed my favorite part of that era, which was in that same year, 1971, Typhoon Connolly, who was the Treasury Secretary at the time, and he was named Typhoon by his Japanese kind of contemporaries there. And I kind of like that. Anyone that gets the nickname Typhoon, like, you can't give yourself that kind of nickname, but it's a pretty cool one. He said famously, "The dollar is our currency, but it's your problem." And he forever immortalized himself in the history of finance with that line, and I love it.
All right, let's move on.
Okay, time for No Stupid Questions. We get
Lena, jump on.
The best of our trio on the line.
All right, so the first question of the week. Would you rather suffer a theta burn, having a 5% portfolio position with Cameco expire worthless on January 15, 2021, or suffer a third-degree burn on your index finger on Christmas Day?
Well, do you want me to go first, Kevin?
Well, you know what? I'm gonna just say something quickly, and then you're gonna do your option magic on this. Patrick likes being long theta a lot more than I do, and part of the reasons that I hate being long theta is because I cut my eye teeth on an institutional equity derivative desk, and index is generally it trades above the realized volatility, and for the longest time, if you were long, theta, you got crushed, and especially when you had a bank's balance sheet, you always made more money on the short side of it. So I really never learned how to trade it properly for the long
But you
side.
should also tell people that you enjoy third-degree burns on your index finger.
Well,
on
I
Christmas.
always say that,
because he's making it a very distinct choice. And you clearly are saying you don't want the theta burn. You would rather
I hate the theta burn. I would rather
third-degree
and it's not really
burn.
a burn. Like, I wouldn't call it a burn. And this is what I wanted to bring up. Our good friend to the show, Jimmy Jude, he had a boss who said, being long theta in a slow market is like being suffocated by hundreds of pillows. And I think that is so true. And
Words of wisdom.
I will take the burn from being short gamma anytime over the pillow suffocation.
So let's make something very clear that our listener who submitted this question did not make clear. They did not point out the strike price from which they were doing on Cameco. So they just chose Cameco, which you just were super bullish on uranium. So the uranium has very distinctly just bullishly broken out in a period where a Santa Claus rally may very well spur markets higher. So this idea that theta burn is guaranteed with Cameco expiring on January 15th, I don't know. It may not be as bad. I would prefer not to burn my index fingers, and so I actually would take the Cameco long. That's just my situation. Maybe 5%, maybe a little too much, but that's my thing. Anyway, that's enough for that. All right, Lena, move on.
Hi, guys. My goal is to accumulate as many shares of a silver miner as possible within my TSFA. I own 400 now. I've been selling covered calls and using the proceeds to buy LEAPS calls on the same stock. When I have made enough for the purchase of an additional 100 shares, I sell the LEAPS, then repeat. Can you tell me the downside or a better way to accumulate? And Patrick, please refrain from saying August and Southern going forward.
Calling me out for my bad English. All right.
Okay. Before, I'm going to just jump in and say one thing for our American and non-Canadian listeners. A TSFA is like a 401, or actually
TFSA. So that's a typo right there. So
yeah, it's actually similar. Maybe it's a Roth IRA. It's similar to, but it's a retirement savings account for us Canadians.
Well, it's just you can withdraw from it any time, though. Anyway, the point is that it's tax-free. And so now the point here is that our listeners pointing out 400 shares, and they've been covered call writing and saying, what's the downside? Well, the problem here is, well, what if silver starts a face-ripping rally to the upside? Well, you're looking to collect a long-term position and build this long-term position in silver, but by having cut off your upside, you risk a period where silver might take off and you're not participating because you've cut it off with the covered calls, and it may simply be moving too quickly for you to be rolling up those calls or adjusting them, or even too expensive to cut them at a loss if volatility was to shoot up rapidly. There is downside. The point is that what you would almost need in order for this strategy to work, which could work, would be you need the silver market to stay relatively stable and systematically rising, almost lumber-wise, but actually lumber is even moving too quickly. But I think that there are a lot of things that could become challenging in the execution of the strategy. Kev, do you have something to add to that?
No, Patrick, you just do such a great job with the options.
But like like in principle, if you can harvest premium off of your shares and use the proceeds to buy long-term leaps, I mean, in theory, it actually sounds really good. It's all about the execution. And man, if let's say silver blasts off and you see silver going from the 20s up to 35, and it happens, let's say in a month or two, you're feeling like a deer in headlights as all your covered calls just get blasted, and you don't actually have the upside of the silver at all. And so it's tricky. If it works, you look like a rock star, but if it doesn't, it's like you're back to cash in your portfolio and having to chase silver higher. Anyway, that's my.
Well,
2 cents.
Patrick, I'll leave you with one thought. That great trader, Yogi Berra, says in theory there is no difference between theory and practice. In practice, there is.
Okay. Where's the wisdom?
From the great trader, Yogi Berra.
There you go. All right. So, Lena, where can they submit their questions?
You can submit your questions for Kevin and Patrick to nostupidquestions@markethuddle.com.
All right. So let's move on. Kev, it's time.
Skin in the game. So not only do I get just like one of the craziest, busiest days, and I'm just exhausted, and then I have to come in and do this show with this guy that, God, I just barely can stand his company, but I always put up with it for a couple hours on Friday. But I keep losing, which is the worst part about this, and I lost again. So congratulations, buddy. You're picking me off on a regular basis.
Oh my God! All I can say is that I wish I took that up to a stake. It was an absolute no-brainer.
Yes. So this is our highest value bet yet. A bottle of wine.
So let's first go through the bet. We bet on going over the Brexit, or at least some further news towards the Brexit. And we basically were straight on over under the Friday closing price of the pound sterling against the US dollar. And it was at the 1.3217.8 level. And you bet below and I bet above. And I thought it was a spectacular opportunity. One, because it was retracing to the downside in a primary US dollar uptrend, which was 2. And 3, you never underestimate the ability of the Europeans to kick the can down the road and delay something that's important. And to me, it was a no-brainer trade. And you just gave me a nice bottle of wine. Thank you very much, Kev.
Well done, buddy. Well done.
So let's see if I can.
To say.
Lena, what's our score now?
Right now, you guys are tied yet? Actually.
See, that Kev, you had that strong start. You had that strong start, and now I'm going to catch up. It's now. I actually had one bet, but I'm going to go another direction here, Kev.
Okay. So for those who don't know, we're actually gonna have shows for the next 2 weeks, but we've already taped them. And so our bet is going to be over a 3-week period. We're going to do it until January 8th? Is that the time?
January 8th is when we're going to be talking about the outcome of this trade.
Right. Oh,
right?
You're going to give me something that's going to have a different timeline. Okay.
Well, I just feel that we earlier in talking charts, you didn't seem to have a lot of conviction on Tesla.
Okay, actually, before you go and give me your bet, I'm going to just tell people the rules of the game.
Go for it.
Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, except for this one, maybe. And the currency for the wagers is as follows. Everybody knows that. No need to tell them that. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. This isn't Lehman Brothers in 2007.
No.
Okay.
Kev, you know what? I know that we're not going to speak. The next time we're going to talk about this is January 8th. But I can't think of a more interesting opportunity for us to make a bet on the Tesla inclusion in the index. And I want to do an over-under where there's going to be a gift to one person or another. 650. That was the high before today's little gapping run higher. And I'm going to literally go 50-50. You literally over under.
Is it a one touch or is this a settlement?
No. And more importantly, so I didn't clarify. It's the close of Christmas Eve. So we're going in just 1 week. It's just about what will it do those few trading in the next week in this post-index inclusion. Will it be above or below 650?
So next Friday, if it closes above or below 650 is my choice.
Yes. Well, but whatever the closing price into the weekend is.
Oh,
because of the
yeah,
market
you're a
closures.
bugger. I just realized Friday's Christmas, isn't it?
Yeah. So the thing
you
is
always
that
try this. You always get me on this part.
no, but
You do.
listen,
Let's
no,
face
but
it.
it's a
You do.
it's a very simple thing. There is
No,
like
you-
whatever
you're always
3.5
thinking
trading
about that.
sessions.
You're always trying to figure out. You're trying to take advantage of my tendency not to pay attention to the calendar. Good for you.
Well-
It's like somebody that's not looking at a calendar and overpaying for vol because they think that that day should be fully priced and it's not. Good for you. You picked me off. I like it. So the 24th is a half day, so it's really only 3 days.
3.5 days.
You bugger.
3.5 days over under 650. Time to make your bet.
You picked a good number because if it had been any lower, I would have taken up. And if it had been any higher, it would have been a no-brainer down. And it's like at the point where I'm thinking about it. Screw you, Ceresna. I'm going down, and I'm taking lower.
You're taking lower.
Yeah. I know you got me. I know you wanted it.
All right.
Well
What do you
done.
want to start the betting?
Well,
So you're
I
taking
need my-
below
I-
650.
I
You're
need
taking
my
below
bo-
650.
I need my bottle of wine back. Let's do it.
No, I don't want that high. No, you got to start lower. You got to start lower, buddy. We got to work up to that. My confidence level's not that high.
Okay.
I'm willing to do a pitcher.
Okay, you're done.
A pitcher of beer.
Yeah.
650 Tesla. I've got over. You got under. I am
Yeah.
not. To be honest, I'm not totally happy with it. But you know what? I'm willing to do it. You know what? I'm getting a really nice bottle of wine for me for Christmas. So it's this is good. All right, Tesla it is. But thank you for your donation for that nice bottle of wine. It's going to make my Christmas really nice, buddy.
If it comes in a box, is it still considered a good bottle?
You know what? I'm going to find one of the most expensive bottles I can stay within the budget, and then I'm going to use it for mulled wine. I'm gonna do it. I'm gonna basically boil it with other shit and just destroy the taste.
I'm going to buy you because I get to choose. You don't get your own.
No,
gift.
what do you mean?
You don't get your own gift.
You
I get
gave
to
me a
choose the wine.
budget. You gave me a budget.
No, I'm going to go and pick you $100 box of wine. It's going to be the biggest thing.
You should get him a rosé.
You might as well just give me a barrel of
A
vinegar.
rosé, yeah, it's going to be even worse
Yeah,
than that.
get
It's
him
going to
a
be a
rosé.
box. It's going to be like a cooler sized box of rosé.
Oh.
I wouldn't do that. I'm going to get you a good one.
All right.
Okay.
All right. All right. That's it. My goodness, it's a shorter show.
It is a shorter show. I'm trying to find my script here and I can't find it, but so we'll just have to wing it. Thank you very much for tuning in. You know the drill. You can find us on iTunes and all the different places. Please go give us a review. We really appreciate it. Also, give Lena a follow on the Twitter at the Market Huddle. It's at the Market Huddle, right, Lena?
Yeah, at the Market Huddle.
And listen, we're gonna have a show as we mentioned this next 2 weeks, but it's not going to be the standard show. We've already taped it.
Christmas specials.
Yeah, I'm not going to tell you who it is, but it is awesome. And that's it. Thanks for tuning in, and we'll catch you on the other side.
All right, Kev, where can they find you, buddy?
Oh, yeah, you're better than me at remembering all these things. I'm at Kevin Muir on Twitter, and you can go check out my newsletter at, themacrotourist.com. Have we lost
And
Patrick?
where they can find me?
Oh, sorry. Yeah, you're right. Patrick, it's been a long day for me. Anyways, we're not editing this. We don't edit, especially when it's me.
I'm not saying anything. The people know where to find me. Fuck it. Let's go to the end game. I need to finish this beer. This is ridiculous.
God.
It's a terrible show.
Oh,
but anyway,
my
so
goodness.
that's what happens when you book it on like a quarterly rebalance. Like it's just these are tough days for me. I'm exhausted. I feel like I just like, and this beer is like going straight to my head.
Yeah, it's
and
a strong
just-
beer.
Yeah. Actually, I realized this is from my daughter's boyfriend, right? This is
I
a new
think
official
we've had
one.
this one before. I'm pretty sure we've had this beer before.
No. We
No.
haven't had this one before, but we've had it from the same company.
Yeah.
Ah.
We've had another one from Big Spruce.
Yeah.
Okay,
We've
so
done
let's give
Big Spruce.
our reviews. Let's do it.
Who's going to go first?
No.
I'll go first.
All right, go for it.
I like it. I needed it. It's gonna be a solid 8.4.
Oh, that's pretty high for you.
Yeah, it is, especially for an IPA. A strong IPA.
Yeah.
You know what it is?
It's the dolphins.
It's the alcohol.
Man. No, it's the dolphins.
You're saving dolphins. I love
I'm
it.
saving dolphins. It needs a high review.
Oh, you're not being easy on your daughter's boyfriend?
Maybe I like the kid. He's giving me beer, so.
Straight to your heart. Hey, what was that comment? One of the Swedish listeners was talking about the bullet.
Yeah, he said that a Swedish listener said something to the effect that the reason they have those beers so small is so that they can drink them and they stay nice and cold.
Well, he used some sort of Latin terms.
Did he?
Anyway,
There was some.
But I was going to
colorful
say, one
terms there.
second. I was going to say, well, you know what? It's we Canadians drink the big ones and we drink them so fast that they still stay cold. But
but it's not only
realized
that,
there
but
was-
it's so
there
cold
was-
up here that our beers never get warm.
cold.
But none of those things work because it's cold in Sweden and they drink even more than us. They really do. I was just completely floored. So I'm just going to shut up and go, I like your little beers. That's it. Yeah. Oh, wait, here it is. Yeah. Okay, so it's Morgan Tesk. I don't know how to say his last name. It says, I hate to point this out. Drinking the long shells, which I don't really, I don't know how he calls them shells, is considered degeneratus maximus, as we say in Latin, for the simple reason that only a degenerate finishes a long shell before it goes warm or fizzless, or he or she doesn't mind a warm beer. Yeah, that is bad.
Yeah, that's pretty
This
bad.
is the consensus in Sweden. Yeah.
All right.
Morgan,
Okay.
I hear you. Well played, Morgan. Well played.
I like the long shell. I'm
didn't
going to
realize-
use that term. I like that. He taught. I never called it a long shell before. I like it.
Well, you
Yeah,
can
so
you
it's
can
a
start
little
calling it long shell when you stop saying August and Southern.
August.
Yeah. Or when he talks about it being
August.
sessionable. Okay, review this bad boy.
I am going to give it. No, I'm gonna give it a safe vote of 7.6.
Okay.
It's a good beer. I'm not gonna say anything bad. I mean, we didn't go down into like 5s and 6s or anything. It's a good beer. I like it. I'm just not gonna give it an 8.5 just because I'm trying to impress my daughter's boyfriend.
I'm not trying to
like
impress.
you.
He's trying to.
Yeah, whatever.
Okay, that's
whatever.
cool. Now, what are you giving it?
Well, you would have given it a shit score so that he tries
no,
harder
that's not
next
true.
time.
The Dolphins really got me. I feel like.
Oh my God!
Dolphins.
What does that have to do with the taste of the beer? We're rating the taste of the beer.
I don't know. It's just the Dolphins. I feel bad. I can't. I gotta help the Dolphins in every way I can. You ever seen little dolphins
I just have
caught
this
in the net?
weird image of Kevin just riding the dolphins. You know, like those where you can go and swim with the dolphins. Those kind of
Oh,
experiences.
I did do that.
Have you done it?
Oh yeah. So here's a funny story. So I did it with my kids, and the first daughter did it. And it was great. And then the second daughter is a little bit. She was a little. She's tall now, or not tall. She's decent height now, but when she was a kid, she was always really little. She did like gymnastics and all these things. So I think you had to be 12 years old to go and do this. But she was a really small 12-year-old. And so when they push you through the water.
Yeah.
So they see Dad, me, and they're like, "Oh God, this guy's fat. Let's get 2 dolphins, right?" So they get 2 dolphins to push me, and I'm still just plowing water, and it's like it's like trying to push a bag of cement through the water, and it's just not going well. And they go through everyone, and then my daughter's last, and they get this one dolphin to push her, and she's so small.
Did she like
I
fly
swear to
off?
God, she started planing. I was
my
actually
God.
really scared. She
That's
just saying
funny.
the dolphin just pushed her, and it was like she started planing and skipping along.
my
I was like,
goodness.
because he's used to pushing like fat idiots like me, right? And then all of a sudden he gets a little
tiny
80-pound
yeah.
12-year-old, and he's like, "Hey, this is easy."
She must have had a time of
Yes.
her life though.
Yeah,
Probably so
well,
much fun.
that one doesn't like animals, and so there was all sorts of things that she's better now, but she didn't like it at the time, and so they take you and you get to go and have those what are those manta rays? You feed them and all this stuff, and she did not like any of that.
Oh.
But the dolphins are nice though; they're kind of cool. You feel a little bit bad, but it seems to be that they treat them pretty well. So I hope it's not a SeaWorld situation.
Yeah, right?
Yeah. That's it. So,
I have nothing else to say, gentlemen and ladies. It was a good show. And listen,
Not
the
really.
next time.
I stumbled all over.
Oh, but I have a
everything and
movie
stuff, but
for
I'll
you
be
guys
better
to
next
watch.
time.
I have a movie for you guys to watch.
Oh, sorry. Go for it. Lena.
Okay.
Go
You
for
got
it.
to watch The Young Offenders on Netflix.
The Young Offenders. Let's have a look. I'm going to Google it.
It's
Who's
got
in-
100% on Rotten Tomatoes.
Oh my gosh.
So you got to watch it. It's an Irish movie, and it's about these two young, like adolescents, these two boys that stumble upon a journey to finding 7 million euros worth of cocaine.
So listen, as you guys know, I think the Irish are the nicest people in the world. And actually, if I had to choose a group to spend the rest of my life with, like if you said you could pick one nationality or one country, without a doubt it'd be the Irish. They make me laugh. They're beautiful singers, and they're just so fun. I love their sense of humor.
Oh, you got to watch
And
it then. Yeah.
I can tell already I'm going to love it because the picture has a guy in his jockeys and a nail gun. Like, what the hell's going on here? Like,
You have to watch it. It's hilarious.
and the other guy's got a chicken and some binoculars. Like, that just.
You have to watch it. It's really funny.
All right, I'll watch it. That sounds good.
I'm going to
It's
watch
like
it. So
over
it's
the
on
holidays.
Netflix,
Yeah,
right?
it's on Netflix.
Okay, well, thank you for that.
So
tip,
listen,
Lena.
for all of our listeners that made it this far,
Oh,
we
yeah.
have to wish them a Merry Christmas, a Happy New Year.
Well,
Like,
no, but
and
we're
Happy
gonna
holidays.
tape a intro and stuff for the other show.
All right. So
Yeah.
then
But,
I,
well,
I'm
listen,
just
if you don't listen
embarrassing
to the other
myself
show-
by trying to be a nice guy.
Yeah,
and
if
it's
you don't
not.
listen to the other show, have a great Merry Christmas, Happy Holidays, and a wonderful New Year.
Well, thanks everyone, and enjoy your weekend.